Hello, I'm Brian Lucareli, Director of our Private Client Services Group and co-chair of our Family Offices team at Foley and Lardner. And today I'm here with James Howard and Stephanie Derks, members of our Tax, Benefits, and Estate Planning Group. That's a mouthful. So welcome both of you, and actually welcome back, Stephanie.
Thanks, Brian.
Today we're going to discuss the Corporate Transparency Act. But before we get started, would you both mind spending a moment with a little bit of your professional background, and then we'll jump right into it.
Go ahead, Stephanie.
All right, sure. So I'm Stephanie Derks, as Brian mentioned. I'm a member of our Estate and Trust practice group. My practice really focuses on a lot working with closely held businesses, transfer wealth planning, and also working with family offices.
Thank you. I'm James Howard. I'm a partner in our tax group, and I do a lot of international tax, and this was why this particular law was intriguing to me, because the disclosure type rules that this act requires, which we'll talk about in a minute, have been in place in a lot of countries around the world, and we've had to deal with them in the international context, but now they're coming on shore, and we'll have to deal with them here in the U.S. next year. Thank you, Brian.
Well, thank you both. We have a lot to unpack in a pretty quick period of time. So James, it looks like I'm going to jump right in with you. So let's kick it off and go. Can you give me a quick summary of the Corporate Transparency Act?
Sure. The act was adopted at the end of 2020 and goes effective January 1 of 2024. The significance of the act is that companies created in the U.S. will have to disclose and file certain information with respect to individuals owning more than 25% of the company or otherwise having control over the company. And one of the purposes of the act was to combat financial crimes, be it tax evasion, money laundering, or terrorist financing.
So, James, do you have a sense how many companies will be impacted by the CTA?
So FinCEN has estimated for us, Brian, in their final rules when they published them, they sent a chart in their preamble and estimates that in 2024, 36 million companies will file beneficial owner information reports. And thereafter, 2025 and beyond, FinCEN estimates that each year more than 5.5 million companies will file beneficial ownership information reports every year.
Wow, that's a lot of companies and a lot of reporting. So what is the expected impact of the reporting requirements?
So as part of those same rules, FinCEN estimated that the cost to the reporting companies in the year 2024 will be almost $23 billion. Wow. And going forward for 2025 and thereafter, the cost to the reporting companies will be over $5.5 billion per year.
So here's probably a difficult question, but one we may not have all the time for. But so who will file the BOI reports within FinCEN?
So the reporting company itself is responsible for filing the report. And what has kind of shaken out over the last 3 years going through this process is that most law firms and accounting firms that we've spoken to have indicated that they will advise their clients regarding obligations and potential exemptions from filing under the CTA, but that the lawyers and accountants will not be the actual person filing the beneficial owner information report to FinCEN and uploading the data into the FinCEN portal that FinCEN has promised us they're going to turn on in January. We've been working with a number of corporate service providers that are putting in place processes to assist clients, including our clients, with filing and as part of those service providers getting their piece of this new $5 billion industry.
Wow. So, well, that's good to know that there are going to be some providers out there that are going to be able to help clients. So Stephanie, I'm going to move this towards you now. So how will the CTA impact family offices in particular?
Yeah, so family offices definitely need to be aware of these new reporting rules and how it may apply to the family office or to the various entities that the family may own. Most family offices are probably going to have to file a report themselves about the family office. Now, there are certain exceptions to this reporting rule that a family office might fall under. For example, if a family office, let's say they have more than 20 full-time employees, over 5 million in gross receipts and sales, sales and have a physical office in the US, they may not have to submit a report. But for the most part, a lot of family offices themselves are going to have to file a report. And then even if the family office doesn't have to file a report, there's a good chance that the family office may be considered a beneficial owner and will need to file information about itself as part of a report for a different reporting company. And there's also a good chance that the family office, works with the family, and that family probably owns various entities that are going to be subject to these reporting rules. And just, kind of thinking through the different planning that we do for a lot of clients, we're creating entities all the time. And something as simple as a family deciding to hold a vacation property in an LLC, that LLC is going to have to file a report under these rules. So just kind of lots to be aware of for the family office.
Well, same thing on the trust side as well.
Yeah, so trusts themselves are not going to be subject to these rules. So trusts, as of right now, aren't going to have to report. But if a trust is a beneficial owner of a company, you'll have to give certain information about the trust to as part of that report.
Okay, well, helpful. And so Stephanie, is this a one-time report, or will the report need to be updated, periodically, or triggers?
Yeah, so the report will need to be updated anytime information in the initial report changes. So let's say a reporting company, a company that was required to file a report initially, maybe they moved to a new building and have a new address. So now they're going to have to file an updated report. Or maybe some information about a beneficial owner changed. So if one of the owners moved, or even a lot of times we're doing planning where maybe we're doing sales and gifts, and all of a sudden you have different owners of a company, or maybe we're changing who has control over a company. These are all items that may affect the initial report, and you may need to consider updating that report with this new information. And if that information does change, you're going to have to file that report within 30 days. So again, just something for the family office to be aware of and thinking through as they're working with various entities for the family.
So it sounds like there's a lot of moving parts here from what you both described. And I'm going to go off script for just a second, and I'm going to toss it out to either one of you. But is there any chance, with year end approaching, that Congress or may extend this beyond the deadlines that have been given?
Very little.
No.
What I tell people when they ask me that question, Brian, and I've given speeches on this topic around the country, and I get that question almost every time. And what I tell them is you have to remember that this act was part of the defense spending bill that was President Trump's very last act on his way out of office. It was signed on December 31st of 2020. And so, we had a Republican president. We had a Republican Congress, as I recall, back in that day, and it still got pushed through.
Wow. Okay. Well, I appreciate the candidness, and so James and Stephanie, I want to thank you both for your time and certainly your professional insight today. And I want to thank all of you for watching our presentation. For more information, please visit us at foley.com under Family Offices. Thank you.